This is Andrew Hecht for Martin Chronicle. Let's go through a number of different markets today. The markets have been really, really volatile because of what's going on in China. We've seen huge moves in the equity markets, in currency markets, and in commodity markets, and that's what we're going to focus on. When you start talking about commodities, you got to start with the U.S. dollar, because the U.S. dollar is the reserve currency of the world, and it is the pricing mechanism for all commodity prices. So we'll start with the dollar, and I want to start by saying that I believe that the dollar is strong, and it has been. It's rallied big time from last May through March. We had a 27% rally in the dollar, so it's really appreciated in value. And now we're going through a consolidation period in the dollar. A lot of people are calling for a weaker dollar here, but I believe that the dollar is only strong versus other currencies. But even the dollar is weak. So fiat currencies are getting weaker, but I am still very bullish on the dollar currently. Now the chart that we have up there is as of the other day, but just to reflect fresh, today the dollar is trading on the dollar index at the just under the 95 level. So it's recovered nicely from the dip that we saw when everything went crazy on Monday morning and the dollar really dipped down. We had a big down day, then we had a big up day on Tuesday, and today we're having another sizable up day. The dollar's up just under 400 points here, and we're almost up to the level that we broke down from on Monday. So we've climbed all the way back, and I believe that the dollar is kind of best in show here. Look, Europe is weak, Japan is weak, the U.S. economy is chugging along. It is showing moderate growth. On a technical basis, the dollar, the slow stochastic, which I look at as a momentum indicator, the relative strength index is kind of neutral here, which is good. Volatility is higher because, of course, what happened Monday here. But right now, I think what we saw is a lot of Chinese selling in the dollar, which brought it down very low on Monday. But I believe it's going to recover, and because I think it's the strongest thing in town on a fundamental basis, because, hey, interest rates are not going down in the U.S., they're going to eventually go up. You know, that makes the dollar more competitive against other currencies in the world where interest rates will remain low. There's still quantitative easing going on in Europe. China is cutting interest rates. They did it again this week, 5 times in a year already. Interest rates remain low around the globe, and the dollar, that will bolster and support the dollar. So the dollar has underlying support under it, and that is not good news for commodity prices in general, because a stronger dollar generally means lower commodity prices because of the inverse relationship between the dollar and commodity prices. So now that we have a basis for the dollar, and by the way, I think that the dollar will go eventually in the coming months to parity against the euro. The euro is now trading at around the 114 level, just below there. I think there's some room on the downside in the euro, room on the upside in the dollar. I expect new highs in the dollar index above the 100 level in the weeks and months to come. So let's move on from there to the next slide, and let's take a look at what's going on in the gold market, because the gold market has been wild. Now, as you can see, gold had a really nice rally from 1073 up to all the way up to highs the other day of we got up to almost 1170. So we had almost a almost $100 rally, just shy of a $100 rally. But it failed to break the 1170 level, and it has moved lower. And today we are at 1124.50. We're down almost $14 on the day today. One of the things that carried gold higher was the fact that Stan Druckenmiller, the former head trader for George Soros at the Quantum Fund and a billionaire himself, bought 2.88 million shares of the GLD as of June 30th. That made many gold bulls positive about the gold market, but the gold market itself has a problem, and the problem is that every asset value is moving down. I've been bearish on gold for a long time, but I did stop out above 1135. I put out another short when it broke down below 1135 here because I believe that now gold will go lower. A lot of things are telling me that today. First of all, the momentum has shifted to the downside. We're down 50 bucks from this week's highs, so that's a big move in itself. More importantly, silver is now trading at 1409. Long-term support was at 1410. We traded down to 1395 today, and the silver-gold ratio is at 76-1, which tells us that either silver's too cheap or gold's too expensive. The platinum gold spread is at a $145 discount to platinum. On a historical basis, the norm for that relationship is a $200 premium because platinum is rarer and it has a higher production cost. So that is also telling us that either gold is too expensive or platinum is too cheap. I think that given that all asset prices and commodity prices are melting down here, gold is too expensive at this current juncture. So that's what's going on in the gold market. I think we're going to get a retest of those lows around the 1080 level on gold. So let's go on to the next chart, which is a chart of copper. Copper has been in a bear market since it made highs in 2011 at almost $4.65 a pound. And as you can see on the chart, it is less than half that value right now. Today, copper is trading at $2.23.6 per pound. It's down 6.5 cents, which is a big move today. About a 3% move on the day. We have declining open interest, which is telling me that shorts are taking profits here on new lows. And folks, this is 6+ year lows. And what copper is in many ways is it is a barometer for the global economic condition. And copper is very important to China. Copper is telling us that things are not well in China. Now, copper, we all know that today, but copper was telling us that weeks and months ago when the price was making lower highs and lower lows. And today copper is following through, meaning that that's telling me that all of the acts that the Chinese government is taking, cutting interest rates, issuing infrastructure bonds, devaluing their currency, banning selling in the stock market or inhibiting selling in the stock market, it's really not working. I mean, these are fixes that are going to take a long time to fix. And copper is in a significant downtrend. In 2000, it down to under $1.25 a pound. In 2000, copper was 85 pound. So there is room on the downside for copper. My target in copper these days is around the $2 per pound level. Now, we'll go on to a market that everyone's talking about and is basically blaming for the disintegration of the stock market. And the reason for that is that so many of the stocks in the indices are involved in the petroleum business, and that is crude oil. And folks, there is really nothing positive to say about crude oil here. And maybe that's the most positive thing in the world. Crude oil has dropped from $107.73 a barrel last June, and right now it is trading at exactly $39 a barrel. So the price has been decimated, and although it is well oversold technically, you have stochastics down in almost at 10, at 13 or so. You have RSI below 30, which is an oversold condition. Volatility is picking up here at around 40% on the daily chart. Open interest has dropped like it has in copper because I think some short positions have taken profits here. But there's a lot of things going on in crude oil that are negative. First of all, there's a big contango, meaning that deferred prices are higher than nearby prices. That tells us that there are big supplies of crude oil in the market. We know that from production. The U.S. is producing over 9 million barrels per day. These are very high levels for U.S. production. Russia is producing 10 million barrels per day. OPEC, which has a 30 million barrel per day production ceiling, is producing 31.5 million barrels as of the end of July, probably more now at lower prices. And with the prospects of Iranian crude coming back onto the market when sanctions are lifted, that number is likely to go even higher. So the supply side for oil looks very bearish. The demand side also looks bearish. Although China continues to grow, it's growing well below what analysts expected it to grow at this time of the year. When growth is slower, demand for commodities is slower, and the demand for crude oil or energy is lower. And so you're getting a double whammy here. You're getting a hit on the production side and on the consumption side, and that is sending prices lower. So we see a wide contango, which means inventories around the world are building in crude oil. We also look at processing spreads, because people don't buy raw crude oil. They buy oil products. We don't go and buy raw crude oil to put in our cars. We buy gasoline. We don't heat our homes with raw crude oil. We heat it with heating oil. We don't, airlines don't buy raw crude oil to fly planes. They buy jet fuel. These are all products of crude oil. And so we can see what demand looks like from the consumers in these product prices. And these product prices are falling. Well, today, for example, October gasoline is down to $1.24.29 a gallon wholesale. This is the lowest level since January. It's down 5 cents today. Heating oil in October is kind of unchanged, but it's at $1.40, which is a very low level. And the crack spreads really tell us, these are the processing spreads, what these products are doing versus crude oil. So today you have the gasoline crack spread in October down $1.87 at $13.15 a barrel. That means that although crude oil is down today, gasoline is down more. You have the heating oil crack spread at $20.08. That's up 14 cents. But heating oil is slightly outperforming crude oil today. That makes sense because refineries are now retooling, switching over from producing gasoline to producing heating oil, because September is right around the corner, and that means that winter is on the horizon and demand for heating oil will be stronger than gasoline because driving season is ending. There's not too many positive things to say about crude oil. However, the lower the price goes, the more the chances of a recovery rally. I hearken back to what happened in March when crude oil bottomed out at $42 a barrel. We had a sharp rally that took crude oil higher, 49% higher in 9 weeks. We got up to over $60 a barrel. Then the selling started again. Now we've made a lower low. But crude oil is a highly political commodity, and one problem in the Middle East with an oil field, one problem, anywhere in the world having to do with logistics or shipping of oil can launch oil in a moment. I hearken back to 1990 when Saddam Hussein invaded Kuwait. The price of crude oil was $20 a barrel. In 10 minutes, it rallied from 20 to 40. So there's always a potential for big volatility on the upside, and the lower we go, the higher that possibility rises. So we have to be a little bit careful here. Every analyst in the world is bearish on crude oil, and with good reason. The fundamentals say down, the technicals say down. However, there is always that chance that something happens in a very turbulent area in the world, the Middle East, to cause crude oil to go higher. Now, the next chart relates to crude oil, and that is the XLE. And the XLE, folks, is the Energy Select Spider that trades on the New York, on the Amex, and that is making multi-year lows today. It is below $60, and the reason that I'm pointing this out is because oil stocks make up a huge percentage of the indexes, and we have seen decimation in equity prices this week. Since last Thursday, the stock market dropped, I think, about 400 last Thursday, about 500 on Friday. We dropped a huge amount on Monday. Yesterday, we were up 400 points, and we closed down 200 points. And at the moment, we're up about 200 points, but who knows what's going to happen the rest of the day. But oil prices, oil stock prices, this is a composite of many oil stocks, are moving lower. So I wrote an article in Seeking Alpha this past weekend called The Mirage of Dividends and Yield in Commodity Stocks. And this pertains really to oil sector stocks. And my contention is that here, for you who are listening, is that these stocks will not bottom until the energy companies cut dividends on their stocks. Because at this point, given what oil prices are doing, particularly the developers and the drillers, they are going to be not making much money. In fact, some will be losing a lot of money, and they can't afford to pay dividends. Now, a lot of companies pay dividends because they have to compete with other stocks for capital attraction. So it's very hard to cut dividends that have been there for many years. And if you all of a sudden cut dividends, many investors will either not buy your stock, or if they hold them, will sell your stocks. So my contention is that we won't see a bottom in these oil stocks as long as the oil price stays under pressure, until these companies cut their dividends and start retaining their earnings. And that is, that's why I have this chart up there. This market for the XLE is really in free fall. Now, the final market that I want to take a look at today is a little bit more of a positive note, and that is the natural gas market. Natural gas has been in a range between $2.60 and $3 way back since, let's take a look here on this chart, about May. And that, the summertime is usually a weak time for natural gas because historically natural gas is a winter commodity that's used to heat. But that's all changing a little bit because coal is dead. And, the administration had announced all these new regulations and stuff to deal with coal and to change the generation of power or electricity from coal-based, which it has been for many years, to natural gas-based. And that's a new demand segment for natural gas. Another new demand segment for natural gas is the fact that companies like Cheniere Energy are liquefying it, putting it on vessels, and intend to ship it to Asia where prices are much higher. Another new demand area for natural gas. Now, natural gas prices are very depressed because there's a lot of new supply in the market. The Marcellus Shale, the Utica Shale in the U.S., it's said to have like a quadrillion cubic feet, and it's a big number, of natural gas reserves. But to get those out, we have to do fracking, and fracking is a difficult process. It's caused a lot of seismic activity in states where they are doing fracking. So there's likely to be some regulations containing some of that production. But more importantly, folks, there is a seasonal tendency for natural gas to bottom in August and rally in September and October. In fact, in 12 out of the last 15 years, we have seen natural gas prices actually increase at the end of August through September, October. And that's why I really like natural gas right now. It's at $2.71 per million BTUs today. The market is oversold here. The stochastics are down in oversold territory. RSI, relative strength, is kind of neutral here. Historical volatility at 32% is very low for natural gas, which historically can trade at 100% historical volatility on a daily basis or higher. And open interest has dropped to 942,000 contracts, which is the lowest level in quite some time. Let's look back on this chart. It is the lowest level since December 2014. There's also a gap on the natural gas chart that dates back to December between around 331 and let's take a look, 336.70 on the October contract. So October natural gas at $2.71, I think below $3, where it's spent most of its time since 1991, is a cheap price for natural gas, and it is the one energy commodity that I like today.
Hey folks, this is Michael Martin. Please take the time to subscribe to the channel and to follow us on Twitter so you can get the updates when we post new videos. Also get transcripts and bonuses. Thanks. See you next week.